Okay, so I assume that we're going to get through the chapter 8 stuff. So I did set the exam to be available for tomorrow. If we don't get through, I'll adjust it. It's not due tomorrow. You'll see the announcement. It opens tomorrow, but you'll have until Monday to finish it. You could do it anytime within that time period. You only get one shot to do it. Okay. And there's 25 multiple choice questions, all worth 3 points. And then there's 2 questions that are more involved, and those are worth 20 points and 5 points. Okay. And there's 2 hours time. So we are on example 2, and we talked about purchase commitments, and we talked about if there's a loss on a purchase commitment, then the loss should be recognized when the loss occurs. And just want to say, keep in mind, gains are not recognized early. They can only be recognized when earned. So basically, if you signed a contract and you're going to take a loss on it, you've got to let your investors, the readers of your financial statements, know. And if there's going to be a gain, you've got to wait until that time takes place to record that gain. So assume that Starbucks signed a contract in early 2025 to purchase coffee beans in 2026 at a price of 10 million. Assume further that the market price of the coffee beans on December 31st dropped to 7 million. So essentially now we have a purchase commitment to pay 10 million for something that is worth $7 million. And so you would record loss on purchase commitments. And your credit would be liability on purchase commitment. And that would be the difference of $3 million. Or roughly what they pay me here, right? Gosh, you guys didn't even pick up your head. That's what I would expect. What entry does Starbucks make on March 30, 2026 when it receives the coffee beans at a cost of 10 million? So purchases, which is tied to inventory, 7 million. Liability on purchase commitment. $3 million. And then you would pay cash for 10 million. Okay, if Starbucks can partially or fully recover the contract price before it receives the coffee beans, it reduces the estimated liability on purchase commitments. In that case, it reports in the period of price increase a resulting gain for the amount of the partial or full recovery. So drought conditions in Latin America have decreased, thereby increasing the market value from its current 7 million to 8 million. And you'd have an estimated, a debit to liability on purchase commitments. And so that would be for 1 million and then gain on purchase commitments of 1 million. Okay, just following along with that now, if you have no questions, we'll go to example 3. Kemper Company signed a long-term, non-cancelable purchase commitment with a major supplier. Purchase raw materials at $1 million. The raw materials can be purchased or to be purchased have a market value of $950,000 at December 31st. And so you'd have a loss on purchase commitments of 50,000. Liability on purchase commitments. It looks like in some of them, they call this liability and estimate. So you may see it as estimated liability on purchase commitment, or you just may see liability on purchase commitments. Okay. Pretty straightforward example. Using that same information, now we're going to pay for it. We know that we're going to be giving up cash of $1 million. We want to eliminate the liability, but also record the purchase. And so that would be for 950,000. And then you'd have a debit to estimated liability on purchase commitments. Any questions there? So determining the ending inventory by applying the gross profit method, for most of the time that you're doing this, you're trying to check your figures. You've encountered some sort of loss, some sort of problem. This would not be something that you would typically use to be sure on your annual financial statements. You might use it on your quarterlies, and then you would true it up with some actual counts to match at the end of year. But it does give the company the ability to price something that comes in, and they use the example of a cow, and it's pretty hard to cost out all the pieces after you've cut up the cow, butchered the cow. So what they do is they say, this is what I can sell it for. This is my profit that's expected. That's how I'm going to value that inventory. So they do use it in some businesses. Okay. So it's used to estimate the cost of ending inventory. It is in general not GAAP for reporting, financial reporting. You know, with some exceptions. And then I also talked about the gross profit method. should not be used as a substitute for annual inventory counts. Steps for using the gross profit method is determine the cost of goods available for sale. And so how do we do that? We add the beginning inventory plus purchases. And then you determine the cost of goods sold by subtracting an estimated gross profit from sales revenue. Excuse me. To determine the ending inventory by subtracting cost of goods sold from cost of goods available for sale. And I'll realize that all we're doing here is we're just kind of manipulating the old setup. So on our old cost of goods sold statement, you'd have beginning inventory, you'd add your purchases, and that would give you your cost of goods available for sale. Okay, now we've started kind of another equation here. And what we would normally do is say, okay, I know what my ending inventory is. I'm going to use that and give me my cost of goods sold. Instead, what we're saying is I'm going to take my estimate of cost of goods sold, and that'll tell me what my ending inventory is. And you're just estimating it based on, you have your sales less your cost of goods sold, and that equals your gross profit. If I know my gross profit is usually some percentage of sales, let's say it's 30%. Well, then I know my cost of goods sold is 70% in this case, because they make up one, right? Sales is 100%. And so they're saying we estimate our cost of goods sold to be 70%, and that's how they're getting their gross profit and your estimated of cost of goods sold, which then they put their estimated cost of goods sold there. And this part kind of gets a little confusing because they talk about markup on cost and markup on selling price, but really it's not as confusing as it seems. Okay, let's take a look at example 5. Lowry stores his beginning lumber inventory of 60,000 and purchases of 200,000, both at cost. Sales at selling price amount to 280,000. The gross profit on selling price is 30%. How would you determine ending inventory amount for Lowry if it used the gross profit method to estimate ending inventory? So we have the beginning inventory at cost, 60,000, plus our purchases, 200,000. And so that gives us a cost of goods available for sale of 260,000. Now your sales revenue at selling price, they said, was 280,000. Less your gross profit, which they said was 30%. So you take 30% of 280,000, and I get 84,000. And so this becomes our estimated cost of goods sold, 196. And our ending inventory would be 64,000. So pretty straightforward. Determine the cost of goods available for sale. Cost of goods available for sale. Determine the gross profit. Subtract that gross profit out of the sales. And that should be what's left over in inventory. Now, again, this is fine for quarterly, but at the end of the year, you can't use the estimate. Example 6. Okay, Fosber Corporation on April 30th, inventory was destroyed by fire. January 1 inventory was 150,000. So we've got 150,000. That was our beginning inventory. And then our purchases through April, so to the end of April, totaled 500,000. And so we have a total of cost of goods available for sale of 650,000. Now it says that sales revenue for the period was 700,000. And their gross profit was 35%. So let's just say 35, right? And so we take 35% of 700,000. I just want to check and make sure my math is right here. Yep, my math is right. Thank you. 245,000. And so your estimated cost of goods sold is 455,000. Excuse me. Sorry about the people on the hearing that. And then your ending inventory, which you thought was destroyed, would be 195,000. Any questions there? Okay, computation of gross profit percentage. So there's kind of two ways that you can do it. The first one would be markup on retail. And that equals your markup or gross profit divided by your retail sales price. And then you have markup. It's probably just one word. I don't know. On cost equals your markup or gross profit divided by your cost. So your markup on retail would equal 5 divided by 20. And so that'd be 25%. Your markup on cost would equal 5 divided by 15. And so that would be 33.3 repeating percent. So if we assume that a company marks up a given item by 25%, oh, that's great. Sorry about that. And so what we're going to do is we're going to look at the formula and we're going to walk through it. Now, keep in mind, this is just rearranged, right? Selling price minus cost would give me my gross profit, right? So all we've done is move cost to the others, or move both of these to the other sides, right? So we added plus cost here and plus cost here. And so we get cost plus gross profit equals selling price. And so they've told us this item sells for $1. So we have cost plus cost times 25% equals $1. Sorry, that was supposed to be a point. And so what is cost plus 0.25 cost? So what do we have? We have 1C plus 0.25C equals $1. And so 1.25 times C equals $1. And so our markup on cost equals $1 divided by 1.25. Or 0.80. Okay, so now our gross profit on selling price equals your percentage markup. So we went from 0.80, right? 1 minus 0.8. And that equals a 0.2 gross profit. And we're going to divide that by the selling price of 1, and so we get 20%. Any questions there? Let's look at example 7. I'll walk you through this. Take a second to read it. Okay, so let's take a look at this. So what is our percentage markup on cost for jasmine and matcha tea? And so we have gross profit on the selling price of 20 cents. So for jasmine, this equals 0.2, which is the gross profit on selling price. And we want to find the cost. And so we have 1 minus 0.2. And so that equals 0.8. And so jasmine is going to be equal to 0.2 divided by 0.8. And so that equals 25%. Now we would expect that, right? When we're talking about a markup on something larger, like the selling price, you would expect the selling price to be more than the cost. So if the markup is 20% on that, you'd expect the markup on cost to be a little bit more. And it's just really what number we have and what one we're calculating it by. So matcha has a 0.25 gross profit on selling price. So cost would be 1 minus 0.25, which would equal 0.75. And so we have GP divided by cost. So we have 0.25 divided by 0.75, and we get 33.3%. Any questions there? Now we're using herbal and chai tea now, and it has a 25% markup on cost for its herbal tea and a 50% markup on cost for its Thai tea. All right, so herbal equals 0.25, right? That's its markup. And we want to divide that by its selling price eventually. And so our selling price equals cost plus 25% of cost. So this equals 1 plus 0.25 or 1.25. And so we have 0.25 divided by 1.25, and that's 20%. Chai has a 0.5 markup, and our selling price is going to be 1 plus 0.5. And so we have 0.5 divided by 1.5, which equals 33.3%. Excuse me. Any questions there? Now we're jumping down to 8. And I'll walk you through that. Take a minute to read it, please. Okay, so let's go ahead now, and we're going to go ahead and calculate our cost of goods available for sale. So we had merchandise on January 1 was 38,000. Our purchases since January 1 were 72,000. We had purchases allowances of 2,400 that we have to subtract. So I'm kind of strict about this. We had this conversation about how you should put things into financial statements, and your words should actually match what you're planning to do. So when I come over here and I write merchandise, purchases, less your purchases, returns, and allowance, I don't need to put a negative in front of this number because I'm telling people subtract that number. Okay. Now, you will see on financial statements, there are some exceptions to that, but in general, I'm a stickler. If you're going to be producing something, you should be really consistent. You shouldn't be, your verbal message should be consistent with your other message. Most times you'll never see that on your test or anything like that, unless it's a project where I say produce it in good form and you've got to follow the format in the book. Okay, freight in would be 3,400. And so this gives us total merchandise available at cost of 111,000. And so now we have to calculate our gross profit. And so our gross profit we know is 33.3%. And that's above cost. So we have 100% plus 33.3%. And so that's 25% of sales. If GP is 25% of sales, then cost is 75% of sales. You know, keep in mind here, you can only have one, right, with sales. So if this is 75, this has to be 25, vice versa. So we want to calculate this. We go 0.75 times 100,000. Because that was our sales. And so that's 75,000. See this, I would put in, because I don't have the less mark there, and that's 36,000. Less the undamaged goods that they noted that they have left available, 10,900. And so their fire loss is, I think that's 25,100. Any questions there? So what do we have? 75,000 ending inventory. $36,000. Less undamaged goods, 10,900. And so the estimated fire loss of 20,100. 25,100, I'm sorry. Any questions? Okay, so the remainder of your handout is some notes for reading. These are kind of the important points that I've highlighted. You won't have a question to calculate it. It's complicated, and it's only used by a very small portion of corporations out there. And so as long as you have these concepts understood, then you'll be able to answer the questions on the test. Okay? And again, it's an open book, so you'll be able to find what you're looking for. Any questions on this one? Okay. Let's jump to our next set of notes, handout number 7. And so this is just kind of the last little part of the chapter, and you can helps you with some of the formulas for inventory and how you would analyze it. So when you present your inventories, some additional disclosure is necessary. The major types of additional disclosure are the basis on which a company states its inventory amounts. So this would be like lower cost net realizable value or lower cost to market. The method used in determining cost. And so we have the four methods there: FIFO, LIFO, weighted average, and specific identification. The composition of inventory. So for example, a manufacturer would break it out to be raw material, work in progress, and finished goods. And then significant, I'm going to call that material or unusual financing arrangements. And so what are some of these examples? These would be non-cancelable purchase commitments, involuntary liquidation of LIFO levels or LIFO inventories, pledged, DGED, yep, pledged inventories, or financing, product financing. So that would be like product financing. Sometimes they'll send cars and they'll say, okay, these are our property, like Ford, for example. They'll say, these are our property. They're going to be on the dealership. We own them. They're going to pay us a fee. And then when they pay it off, they're going to pay us for the car plus whatever interest that we're owed. Okay. Now I did this kind of earlier today, and I like to see how this stuff kind of goes out. So I just randomly pull up SEC filings. By the way, I think in general, it's better to go to the company site for investor relations than to go right out to Edgar. Although the company, you'll have to make sure that if they made any adjustments to it, you know, they posted them to Edgar or it was revised. So we have all this stuff that goes into one financial statement, and Apple's was 80 pages. I think I had 159 when I pulled up Caterpillar earlier. And really, what our little part of it is just these financial statements. So that's the income statement, comprehensive income, then you have balance sheets. So, you know, they just put inventories in here and you've got $6 and almost $5 billion of inventories. But companies should always provide footnotes on inventory if I didn't roll past it. I have to do a search for it. There's no necessary order that they're going to put it in. Sales. All right, so I got to look for it. So this is all they give you here. Inventory is measured using the first out in, first out method. I guess they talk a little bit about it in revenues as well. And then they give you some information in their early disclosures on it, but not in the financial statements. But here is, in addition to purchase commitments risk. So sometimes you have to kind of dig around and look for this stuff, where they're going to put it, but they should be disclosing that information in their financial statements. But remember, accounting is never black and white, and so there's always different parts that you can look for it. So that's where it puts it in the risks. And that's their disclosure in the notes. Let's look at Caterpillar. By the way, usually whenever you look at the financial statements, they'll start with a management report on internal control, and then the auditors will report on their internal controls, and they'll report on the auditing itself. This one is an interesting opinion because it looks like they had a disagreement with their auditor. And so this is one where if you ever need an example of it, you can see what the auditors are bringing to the attention. So they sign off on the financial statements and on the controls. And when I say sign off, management is responsible. The auditors just audit it based on procedures. So here's our inventories here. 16 billion. Ooh. And then we state them at lower of cost or net realizable value, determine cost using last in, first out. And LIFO represents about 60% of the total, 65% of the total. And when you use LIFO, you have to tell people what it would have been if FIFO was used. So you report that as well. It's credit commitments, that's not inventory. So here we call it commodity price changes, material prices increases, fluctuations in demand of our products, services. And so they put in here, rely on suppliers, da, 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 da. And if there was purchase commitments, that would be in there as well. Hope it's useful to kind of see how financial statements are messy and they're challenging. One of the things that investors have trouble doing is looking at the notes. They want to focus on exactly what's on the face of the financial statements, but the notes are where you get details, and you should always look at the notes when you get an opportunity to. All right. Inventory turnover measures the number of times on average company sells the value of inventory during the period. So essentially they're saying, what is your average inventory and how often do you sell it? Okay, and so we need the definition for average inventory. And so that equals beginning inventory plus ending inventory divided by 2. And then inventory turnover equals the cost of goods sold divided by the average inventory. So what does this tell us? It tells us how quickly we're moving our inventory. Where is this helpful for us? How do we want to use this inventory turnover measure when we're analyzing? So if we're looking at it from their perspective, right, that management cares about what they're selling and how quickly they're selling it, right? What about outside from investors? Right, but this one's not going to help you with profit margin, right? You absolutely want to know. But if I ask you to give me, inventory turnover, if I ask you to just give it to me for 2023, is that informative to you? Not necessarily, right? What do I want to be able to do? I want to be able to analyze it year over year. So usually companies have 3 years worth of balance sheet data. They're only required to have 2. And then I think the income statement, they're required to have more. But it allows you to compare from both years the information. And so you can see, is this trending in the right direction? How is the company doing? Where else can you use them? You can use them to compare to other companies. Now, I wouldn't compare Caterpillar to Apple unless you're just kind of discussing it in class, but you can pull up a competitor of Caterpillar and see if they're selling their inventory as quick as well, right? I don't know if Kubota is a public company or not, but that's one of the ones I can think of that's a competitor with there. But this gives us the ability to look at what's going on in their financial statements and assess whether or not it's a good trend or a bad trend just looking at them, and then to look at it relative to their competitors as well. So when you see these ratios, always try to put in your head, what am I using it for? Why does it help me? And really keep in mind that I want to look at year over year changes, but I also want to compare it to the industry and other similar companies. Average days to sell inventory. So this is the number of days on average a company sells its inventory. And that formula is 365 divided by inventory turnover. Sometimes you'll see it as 360 just for easy calculations for the number of days in the year. And so we have just a couple examples here I'll walk through. Okay, so the first one, it says that it reported beginning inventory of 199 million and ending inventory of 1.83 million. Three 827, and we're going to divide that by 2. And we'll just 1913.5. Keep in mind that we're in millions, right? So that's our average inventory. And we want to find the inventory turnover. So that equals our cost of goods sold divided by our average inventory, which equals 9,789 million divided by 1913.5 million. And so we end up with 5.12 times. So Gap sells their average inventory 5.12 times a year. Is that a lot? I don't know. If I look at their trend, that's what I care about. Look at last year's, look at the year before, see what's trending and what's happening. If I know anything about brick and mortar stores, probably getting worse, right? Brick and mortar stores aren't doing as well as the ones online. And then we needed to calculate the average days to sell inventory. $365. Bless you. Sorry, I know you got that from me. Divided by 5.12, which is our inventory turnover. And so that would be 71.3 days to sell the average inventory. And then the last thing before we get out of here. Inventory turnover, cost of goods sold divided by your average inventory. And so for our current year, 5,484.8, probably in millions. Yep. And we're going to divide that by the average inventory, so 934.2. Plus 1,044.8. 1 divided by 2. And so that's 5.5 times. Prior year, 6234.9 divided by 1044.1 plus, and it says the beginning of the prior year inventory was 1642. Oh, my neighbor's calling me. Dog must be bugging him. And we're going to divide that by 2, close the parentheses. And that must 4.6 times. So how would you feel about this? In my opinion, better turnover and lower inventory. And we also need to calculate that B, average days to sell inventory. And so we have the cost of goods sold. Sorry, 365 divided by the inventory turnover. 65 divided by 5.5, 66 days. And then 365 divided by 4.6 equals 79 days. Any questions? Well, I mean, I don't know necessarily that it would show up in your inventory turnover. Because if you had low inventory, you would sell out of it quickly. I don't know the answer to that in just kind of giving you one analysis, but you really would look at companies that compete with them and see and say, why is this happening? Because if we had done some of that in the past, just looking at companies like WorldCom decided, hey, I'm not going to expense stuff that's supposed to be expensed. So they capitalized it. It doesn't flow through the income statement. They're doing better than everybody else in the industry. If everybody started looking at these ratios, they'd say, why is WorldCom doing so well? Instead of investing in it, they'd be looking at these ratios and saying, your expense rates don't look right. Let's get it fixed. But what happened was it ended up being a large fraud on them. But the answer would be, I don't have an exact number there, although they may quote you one in the book. It's just, you want to make sure you're keeping up with your sales and you're not cutting sales off. Good question. Anything else? What's that? Oh, this sheet? Oh, you should have told me. I'm sorry. I thought I put it up. It has like a group problem on it. It is, so it's on the bottom of that. That's the old one. I put your group problem online for this one. Right. So I just took it off there, but that is the correct one. All right. Thank you. Any questions or problems with the test, please email me, text me, whatever you need to do, okay?